Money laundering is the process of taking illegally obtained funds and making them appear legitimate to use for legal or illegal activities. Criminals engage in money laundering to conceal the origins of their profits from illegal activities, such as drug trafficking, arms sales, and organized crime. They achieve this by disguising the source of the funds, altering the form of the money, or transferring it to locations where it won't attract attention. Established in 1989, the Financial Action Task Force, FATF, was formed by the group of 7 nations to set international standards and combat money laundering. FATF has shown through various exercises that money laundering can occur through various mediums, financial institutions, and businesses, not just cash transactions. According to the United Nations 2000 Convention Against Transnational Organized Crime, Palermo Convention, money laundering involves converting or transferring property derived from criminal activities to conceal its illicit origin or assist others in evading legal consequences. It also includes hiding the true nature or ownership of property derived from crime and knowingly using such property. A crucial aspect of money laundering is knowledge of the illicit source of funds. Many jurisdictions consider deliberate ignorance or willful blindness as equivalent to actual knowledge. After the events of September 11, 2001, FATF expanded its focus to include countering the financing of terrorism, CFT, recognizing that terrorists and money launderers may use similar methods to move funds discreetly. Terrorist financing aims to conceal the purpose of funds rather than their source. These funds may come from legitimate sources and are used for various expenses related to terrorist activities, including operational costs and material support. FATF has since revised its recommendations to address the prevention of the proliferation of weapons of mass destruction, WMD. Money laundering typically involves a complex series of transactions that are challenging to unravel. However, it's often categorized into 3 stages. Stage 1, placement. This involves the initial introduction of cash or other assets obtained from illegal activities into the financial system. Money launderers accomplish this by integrating the illicit proceeds into various legitimate channels, including formal financial institutions, casinos, and businesses, both domestic and international. Examples of placement transactions include mixing illegitimate funds with legitimate ones, like depositing cash from drug sales into a locally owned restaurant with high cash flow, purchasing significant stored value cards using cash, exchanging illegal funds for foreign currency, dividing cash into small amounts and depositing them into multiple bank accounts to avoid detection, physically smuggling currency across borders, repaying legitimate loans using laundered cash. Stage 2, layering. This stage involves separating the illicit proceeds from their origin by conducting multiple financial transactions to obscure their source and ownership. Examples of layering transactions include transferring funds electronically between countries and diversifying them into various financial options and markets, moving funds between different financial institutions or within accounts at the same institution, converting cash into monetary instruments, reselling high-value goods or prepaid access products, investing in real estate, legitimate businesses, stocks, bonds, or life insurance products, using shell companies to hide the true owner and assets. Stage 3, integration. In this final stage, laundered proceeds are reintroduced into the economy through apparently legitimate transactions, such as investments in real estate, financial ventures, or luxury assets. At this point, distinguishing between legal and illegal funds becomes extremely difficult. Examples of integration transactions include buying luxury items like property, artwork, jewelry, or high-end vehicles, engaging in financial arrangements and ventures that allow investments in business enterprises. The economic and social impact of money laundering. Money laundering stems from various criminal activities that generate profits for those involved, transcending geographical boundaries. Regions with weak or ineffective anti-money laundering (AML) and countering the financing of terrorism (CFT) regulations are particularly susceptible. Yet, even well-established financial centers are not immune, given the vast number of transactions that occur and the array of services available, allowing launderers to operate inconspicuously. Launderers typically aim to integrate their illicit gains into stable financial systems for subsequent use. Money laundering has significant adverse economic and social ramifications, particularly for developing nations and emerging markets. The unimpeded movement of funds between organizations or lax systems that facilitate fund placement without scrutiny provide fertile ground for money launderers. Upholding legal, professional, and ethical standards is crucial for maintaining the integrity of financial markets. Unchecked money laundering poses several potential macroeconomic consequences, including increased exposure to organized crime and corruption. Successful money laundering enhances the profitability of criminal activities and can attract criminal elements to jurisdictions perceived as havens for such activities. Limited predicate crimes, inadequate enforcement of laws, and weak penalties contribute to the proliferation of organized crime and corruption. Undermining the legitimate private sector. Money launderers often utilize front companies, businesses that appear legitimate but are controlled by criminals, to obscure illicit proceeds. These entities gain an unfair advantage over legitimate businesses by subsidizing their products or services with illegal funds, impeding fair competition and distorting market dynamics. Weakening financial institutions. Money laundering and terrorist financing can destabilize a country's financial sector, leading to the collapse of individual banks and other financial organizations. Compliance with AML/CFT regulations is essential for financial organizations to maintain their operating licenses and avoid severe penalties. Dampening effect on foreign investments. Perceptions of compromised commercial and financial sectors due to money laundering can deter foreign direct investment. To foster a conducive business environment, countries must address these concerns to attract investment. Loss of control over economic policy. The substantial sums involved in money laundering can dwarf government budgets in some emerging markets, leading to challenges in economic policy control and potential policy errors. Economic distortion and instability. Money launderers prioritize protecting their proceeds over economic growth, leading to investments that may not benefit the host country. Furthermore, funds diverted from sound investments to conceal their origin can impede economic development. Loss of tax revenue. Money laundering undermines government tax revenue and complicates tax collection efforts, resulting in higher tax rates and reduced revenue streams. Risks to privatization efforts. Money laundering jeopardizes privatization initiatives by enabling criminal organizations to exploit privatization tenders, potentially leading to economic losses and undermining public trust. Reputation risk for the country. Countries identified as money laundering havens face reputational damage, hindering economic growth and international collaboration. Rebuilding a tarnished reputation requires substantial resources and concerted efforts to implement effective AML measures. Risk of international sanctions. To safeguard the financial system, international bodies may impose sanctions on countries perceived as facilitating money laundering and terrorist financing, further isolating them from the global economy. Social costs. Money laundering contributes to social costs by fueling criminal enterprises and increasing government expenditure on law enforcement and healthcare. Financial institutions dealing with laundered funds face operational, legal, and reputational risks, including loss of business and regulatory penalties. Efforts to combat money laundering are essential to mitigate these risks and uphold the integrity of the global financial system. International standards and guidelines set forth by organizations like the Basel Committee on Banking Supervision and the Financial Action Task Force play a crucial role in promoting effective AML/CFT measures worldwide.